Hello, this is Tim Congdon, Chair of the Institute of International Monetary Research at the University of Buckingham. It is late June 2026 in a rather hot and sticky Gloucestershire, part of England where I live, and I will probably be showing signs of the heat wave in this presentation. Anyway, the focus in these videos is on monetary trends in the main nations, and that will certainly be the case in the present video. I really just got two core messages. The first core message is that in recent months the rate of growth of money on the broad definitions in the USA has accelerated, and it's fair to say that for 6 months, perhaps a year now, the underlying rate of growth of broad money has been in the 5% to 10% band. Obviously fluctuates from month to month. And that this rate of money growth is too high to be consistent with 2% inflation over the medium term in the future. That's one core message. The second core message is that central banks have learned nothing from, and indeed also economists in general, have learned nothing from the inflation flare-up of the early 2020s. You will recall, if you've been following these videos, that from early 2020 I warned that the money growth acceleration then underway would lead to an inflation flare-up, particularly in 2022 and 2023. I was a lone voice, I was correct. My profession has reacted with complete indifference to what I've been saying, and instead has adhered to, in my view, faulty and unsatisfactory approaches to inflation analysis. The importance of that is that don't expect commentators, central banks, other economists to pay any attention to the money growth uptick in the USA or to express any concern about the medium-term inflation consequences. Okay, those are the two main points of this video. Now I'm trying to develop them a bit more. I'm developing the argument which really began in a way, well, some time back, but particularly in a video I gave last November. Now, everyone knows the USA has a vast budget deficit and growing public debt. What I showed in that video last November was that the debt was being shortened, the residual period to maturity was being shortened, and the new bonds and bills and notes and things being issued to cover the deficit were, and also to cover maturing old bond issues, were particularly at the short end, and this was being accompanied by very rapid growth in the balance sheets of money market mutual funds. If you take it that money market mutual fund shares are money, which I do more or less, but for debate, then this was a crucial part of the story about the inflation risks being run because of the large US budget deficit. Various things have happened since then. I should just say that I'll talk about it in detail here, but the shortening of that debt, of the US public debt I mentioned last November, hasn't continued. The maturity composition of the debt has been pretty stable in the last 6 months. There's been no further tendency towards shortening of the debt. However, there has been continued rather fast growth of money, and in that last 6-month period, it's been particularly, in fact, in the banking system, not in money market mutual funds. This is a chart that I've sent out in the last 2 or 3 monthly emails, but I updated it to the 10th of June. The blue line is the 3-month annualized growth rate of bank deposits. Bank deposits are most of money. I keep on repeating these things, but companies watch very carefully what's happening to their bank, the money in the bank, because that's really what drives the business. Fund managers care about the ratio of bank deposits, money to total assets. We all have to have some money in the bank to continue to buy things. So there's this stable relationship in the medium and long run between the amount of money and the amount of spending, and that is the core idea behind monetarism, the quantity theory of money, and so on. So if you get, as we have here in these last few months, a 10% growth rate of bank deposits, that isn't consistent with 2% inflation. What I've also got here is numbers for the growth rate of bank credit to the private sector in the USA. That's shown by the orange line. Rather high. You can see it dipped down in the last few weeks. It's typically up in the 6, 7, 8, 9% area. Just to get clear that this is a change of trend, what I've done here is to show you the 3-month annualized growth rate of bank deposits going back a bit further, in fact going back to the start of 2022. Now, what you've got here is in 2020 and 2021, there are explosively high growth rates of broad money. I gave my inflation forecast, they were correct. You then had a period of about 2 years when US broad money growth was negative. I spotted this sort of May, June 2022, said inflation would fall, inflation did fall. Anyway, that period of contraction of broad money ended in 2024. And then you can see this period from kind of the middle of 2024 through to, say, the middle of last year, more or less, when the growth of bank deposits was positive, that was no longer contracting, but it was typically quite moderate, 0 to 1 to 2, sometimes 4 or 5, but most of the time. And in fact, in that, if you take the whole of the period from the start of 2022 to the end of 2025, the average growth rate of broad money in the USA in that period was only 1% a year. All right, that's that orange line just there. Okay. Now then, you then see what's happened in the last few weeks and months. Much faster growth of money, clear break of trend. Okay. So that's what we're worried about. I have said earlier on that the boom in money market mutual funds that we saw through the early 2020s hasn't really continued early 2026. This just repeats a chart I gave with the November presentation. I've just added one more value, but it doesn't matter, it doesn't make much difference. The growth rate of money market mutual funds in the first quarter of 2026 was very low. It's picked up a bit in recent weeks, but a bit of a detail. If we try and summarize all these things, the growth rate of broad money has clearly accelerated. The kind of broad money numbers needed to deliver 2% inflation are, say, 1% a year to 5% a year. Those kind of numbers may be 6% a year, but not much more than 6% a year, please. We had those numbers in the 2010s. We had subdued inflation in the 2010s too. We had the money explosion of the early 2020s. We had a surge in inflation. The model keeps on coming back. We've got this blip upwards now, very clear in broad money growth. Why has it occurred? I would say it's occurred principally because of the American budget deficit and this need to finance deficit at the short end by issuing bills on very short-dated paper to money market mutual funds, also to some extent the banking system, even in some cases actually the debt being picked up by the Federal Reserve itself. And that's not going away soon. The second aspect here is that the American authorities are easing up bank regulations. It's part of the Trump agenda to deregulate the economy. I showed you earlier that's not that dramatic, but it was there, that acceleration of the growth rate of loans and leases in the American banking system, bank credit. So if we take it that those two things are still there, this kind of rather high growth rate of broad money, it seems to me, is likely to continue for some time, probably indeed to the end of the Trump presidency. You'll remember that at the end of last year, October 2025, I published a book in which I set out my analysis of the inflation of the 2020s, pointing out that right from the start of the process, right at the beginning of COVID back in March 2020, I'd said that official announcements on budget deficits, on quantitative easing, on other things implied there's going to be this burst of rapid money growth. I then said there'd be this inflation flare up, all absolutely correct. I also argued for, defended a monetary approach to the determination of inflation of goods and services prices, but also of course of asset prices. And I would have hoped that this book has had some effect on the economics profession, because as I kept on emphasizing in this debate, this episode, I was pretty much, not entirely alone, but pretty lonely. Anyway, we have now a number of analyses from economists, from other economists, from central banks, and I have to report that there's very little interest in a monetary approach to inflation analysis. Instead, what central bank economists and economists, the IMF, the OECD, the BIS, and so on, what they all do is to try and predict the various cost constituents that go into the overall total price level. The explanation of the inflation of the early 2020s is not monetary. Instead, it's to say that there are all of these supply-side shocks, with, for example, a focus on Putin's invasion of Ukraine in February 2022. One has to repeat again and again, I'm afraid, but that inflation was already taking off, been taking off for 6-9 months, well before Putin's invasion of Ukraine. And of course, oil prices a year later, after February 2022, had actually fallen back to where they were in late 2021. There's also some American economists who focus on fiscal policy. A chap called John Cochrane, Hoover Institution, Larry Summers, Harvard. I've dealt with them in the book. I won't go through it all now. All I want to get over to you is that my kind of analysis is still regarded as maverick, despite its success, and do not expect policymakers to be in the least bit worried about the current upturn in broad money growth in the USA, and they will not draw any conclusions from it about inflation risks they're running. They're wrong, but that's what they'll do. Just to get that clear, I'm going to refer to one specific piece of work, and then I'll stop, which is actually a paper from the Federal Reserve, with indeed the title, A Retrospective on the Federal Reserve Board Staff's inflation forecast errors since 2019. Now, you might think that there'd be something in this paper about the money explosion of 2020 and the rather high money growth of 2021. There isn't, nothing at all. Instead, and do please have a look at it, it's very easy to download from the Federal Reserve website. It's by 3 economists, with a chap called Jeremy Rudd as the most prominent. It's said the paper is for discussion. This is not an official view from the Fed. Nevertheless, it is a typical view from Fed economists. So we had this very clear inflation flare up, inflation going to 5 times the 2% target and so on. And so we get, as a verdict, in the final conclusion of this paper by Rudd and Peneva and Villar, we have As a result of all these things, the staff's basic inflation framework should still be useful going forward. Staff members will also stand ready to deviate from it if a new set of indicators that they're now watching closely start to suggest significant risks to the forecast. There's nothing in those new sets of indicators that's monetary. In my view, the Fed hasn't learned anything from this episode, and the Fed is pretty representative of central banks in general. You've been warned. Thank you.